Good morning, folks. My Discord's acting up. 1 second. All right, good morning. Just getting everything fired up. Had a technical snafu this morning, so I apologize about the late start, but it's going to be a jam-packed session, so definitely stay tuned. All right. So we've had some crazy moves in gold and silver, and I know that's been on everyone's minds. What's going on in the precious metals? That's something I plan to talk about quite a bit today during today's session, as I think that's an important area. It's certainly record breaking, the moves that we've had, both in terms of the highs and the velocity of some of those moves, and I think that's certainly worth some exploration during this morning's session. We'll also talk about the S&P 500 and the NASDAQ and what's going on there. Just putting out a couple of posts to make sure that folks are able to tune in. And feel free to share this as well if you enjoy my streams and you've got some social channels or otherwise want to notify colleagues, friends, etc. Always appreciate that. All right, so let's dive in to what all is going on with these markets. And apologize, my presentation got a little funky there. First, of course, there's the disclosure. And really, this comes down to just don't risk more than you're willing to lose. At the end of the day, that is a simple mantra. If you look at your account and you say, shoot, I'm nervous, I can't sleep, I don't know what I'm doing, downsize, diversify, get to a point where you can sleep at night with the risk you have on. When market turbulence hits, if you're too leveraged, you're going to get kicked out of those positions you love, and then you're not going to be able to see any kind of gains they might be able to register. Also, don't put strong emotions into these positions. Like, this is going to be the one that lets me retire, or this is going to be the one that lets me, quit my job, etc. Because often is the case when we get that wrapped up in an idea and it sounds good, we hurt ourselves, right? We get so sure of it, but you got to think there's a lot of other smart people out there that could have been sure of it way earlier than us. They may even be the ones selling that idea to us, selling us the shares, letting us hold the bag. So the whole point is just trading last a while so you can get good at it, so you can enjoy the process of becoming better at it, so that then over time you can start to build wealth with your skill and your knowledge. And not only is that far more satisfying of a journey, but you're also more likely to keep it. Because if you make bets and you win bets, you're gambling and you're likely to eventually lose everything. But if you really focus on trying to put yourself on the right side of probabilities, you manage your risk carefully and you trade systematically, you're more likely to become consistent enough to build wealth. I can't tell you how important that is. Governing expectations, having them be grounded in reality, and being patient with yourself and the process. Trading is not easy. 97% of people that try to get into trading fail. And then in terms of prop firms, only 4% of users at prop firms ever get a payout. That's across all the accounts they ever open over the entire time span. So at the end of the day, what that means is that trading is not a game to take lightly. The odds are thoroughly stacked against you. You have to take it seriously and you have to respect the market. For me, this has been a trade, if you will, that I've been in for 21 years. I know I'm dating myself, but I would not change a thing. The ups, the downs, the journey, having learned what I've learned, having gained what I've gained. It's been absolutely incredible. And one of the reasons that I do what I do, helping other people become more proficient at trading, is because I want to pay forward some of that good fortune, some of the luck I had meeting some great mentors early on in my journey. And also because I realize that these, really the environment out there is not an easy one for most people to navigate. It's constantly changing too. So once you think you've got it down, the regime changes and all of a sudden it's completely different. I've worked with folks both in my Traderade Discord community and in one-on-one coaching, helping them to improve their awareness of what moves markets, where some of these levels of risk and reward might exist. We've even built tools specifically for that, like the options viz, which allows us to get a better idea as to what options are doing in terms of driving price action and key levels of support and resistance in the market. Because we know options are the tail that wags the dog. So we've really got to respect their role and pay careful attention to how they're trading and where they're trading. Now, one thing throughout this session, if you have any questions, let me know. I will be checking in periodically to try to address any and all questions, whether they're on X, whether they're on Discord, whether they're on YouTubes. And there's a plurality of YouTubes here because we're on a couple of them. Put them out there. We're also on Substack, Kick, Twitch, kind of going all over the place today and every session. But the point being, I want to reach as many people as I can, try to help as many as I can. And of course, I'm hoping to help to grow the Bookmap business and my own business because I think both are high quality businesses that really do help traders. So there is a core of benevolence behind all of this. I really enjoy trading too. You could probably hear it in how I talk about it. It's been a really, really, really fun journey. And I feel like it's just getting started. Even though I've been doing this for 21 years, I could easily do another 21 more. Good morning, Voyager. Good morning, Loki. Good morning, everyone tuned into the stream here. If you're enjoying it, like, share. If you're on the YouTube, subscribe. Check out more content. Got a history of all the streams and other videos. I've got a psychology video on my YouTube. I recommend every trader watch at least once. I know it helped Loki out a bunch with his trading, but for everyone out there that's really trying to figure out what's my biggest obstacle, I'm going to tell you right now, it's probably your mindset. And if you can start addressing that, you will improve over time. Address your psychology. Invest in yourself. That's the way where you really get the best returns. All right, so let's dive into some charts. There's a lot of ground to cover before the market opens in about 15 minutes. I want to talk about the S&P 500, the NASDAQ, gold, silver, and Bitcoin. And we're going to go a little bit beyond just price charts. Welcome, Antono. Welcome, Denny. First chart we have here is of our friend, the S&P 500. And once again, we're in a range. Although it's starting to feel like it wants to break the top side of this range, possibly as early as today. I will say Tuesdays have about a 60% chance of being double break days, so just be cautious of that. I know that traditional thinking is once we break out of the opening range one direction or the other, and build acceptance, we're more likely to have a trend day. Tuesdays like to throw a little bit of a like an uncertainty enhancement into that equation. So just be aware of that potential that you could have an opening range break higher and still break the bottom of the range with something like 60% certainty, just like the inverse of that equation. We're just looking at data going back 5 years to draw that conclusion. But overall, what I'd like to see is the S&P 500 be able to break above this range, ideally even above the last top, and build some acceptance to say we're ready to start moving into a new trading range. We do have the SPX or S&P 5000 or 500. S&P 500 calls it 7,000. A little light on sleep, so there's that. Forgive me in advance. But that's something to pay attention to as well. That's an area that's sort of a wall of calls. And if we're to map that level out, that's going to be 70-30 in S&P 500 futures terms for the March front month contract. So basically what we're really wanting to see is a break above that wall of calls. The last time we got rejected, you could see that little bump up here. That was just around that call wall, just under it. And it was a pretty nasty rejection, as you can see. Now, I will say the notes that we've been looking at in terms of sentiment, positioning, flow, at around that time, it was really, really stretched. We've come in just a little bit with this most recent flush. So I think we're in a better position to actually try to take this out. But again, watch the wall of calls. Right now, that delta is 30 points between the S&P 500 index, that's the cash index, and the March front month futures contract. So that's a spread of 30 points. This is what happens when you're looking at futures, which are trying to price in future pricing, versus the cash index. And that delta will gradually shrink as we approach the March expiry. I mention that because it means it's not going to stay at 70-30. If indeed we kind of struggle here for a bit as the days go by, that call wall in ES terms drops because the delta is shrinking as we approach the expiration of that contract. But nevertheless, let's watch the top of this range around 7,000. Let's also watch 70-30 today. Those are two really important levels of potential resistance for the S&P 500. And if we're going to take a look at the options, here's that 7,000 contract. You want to see something kind of crazy? They're starting to roll higher pretty meaningfully to 7,100 and 7,200. So there is some more confidence in upside growing. There's also some more interest in downside hedges, 6,900 and 6,800. Negative gamma, or basically where there's put positioning, is also lighting up on the options chain. So we can see there is some downside protection being bought, which makes sense. We've got a big several weeks of earnings ahead of us. So many companies in the S&P 500 reporting this week and next week. So there's going to be some protection. There's also going to be maybe a bit of a lack of conviction until we get through some of these bigger earnings. That's one reason I think we've had trouble decisively breaking higher, and we've seen some de-risking and hedging flows into those attempts to move higher. We can see a very similar picture with the NASDAQ. We are more or less caught in this trading range. We also have a wall of calls just overhead that we're starting to break above, which looks good. It does look like tech wants to try to make a push. And this would be a very constructive resolution to what was starting to become a little bit more of a concerning pattern, only because we haven't been able to break above this uptrend line for so long. And we've had so much resistance at the call wall on the NASDAQ. So to see some signs that we're finally starting to break above is quite constructive. Again, big tech earnings are going to have a major role as to how this ultimately resolves. So I think it's going to be worth being a little bit more cautious about having high conviction here until we get the results of companies like Apple, Amazon, Alphabet, Microsoft, Tesla, and of course later we'll also get the biggest company in the world's earnings, Nvidia, which generally the health of that company has to do directly with the shininess of Jensen Huang's leather jacket, and lately it's been pretty shiny, so he seems pretty confident. Let's shift it up here to gold. Gold is seeing an expanding range of prices here. This is almost like a bit of a megaphone pattern. But what we're really seeing with gold is that last channel we had drawn and talked about, well, maybe we'll get some resistance there. We did initially, but then we were able to break right above it. And we've had plenty of catalysts for this. Why do precious metals move the way they do? They move the way they do right now because they are in an environment that's pretty much the perfect storm for a relentless bid. You have fiscal policy that is very aggressive here and in other countries. Deficit spending is quite high, which really does mean you're creating new money, and that's reducing the value of existing money, which is bullish for metals priced in the same currency. But you also have widening levels of uncertainty in the global economy, in geopolitics and trade and otherwise. That's also quite bullish for precious metals, as is this trend of de-dollarization, which is something that's really picked up over the last almost 4 years here. And we'll talk about why. But first, I think that gold is very likely to hit $6,000 an ounce by the second quarter of this year. I don't think this rally is over. And actually, I think gold's going to take the reins from silver for a little bit, as silver has to hopefully, and if cooler minds prevail, consolidate a little bit to build a little bit of healthy market structure so we have some area of support to fall back to, but also just so we don't go even further into parabolic territory. The way silver's moving actually concerns me a bit with some of the other things we're seeing in its backdrop. But there are signs to remain bullish over the intermediate to longer term. Near term, we might have some turbulence. Shifting back to gold, there is a wall of calls here in GLD at 465. That is going to be an area overhead that may provide some resistance, and certainly going to be worth watching as we're looking at the precious metal and how its ETF trades. Yesterday, we saw the biggest flows into the silver ETF ever, by the way, 32 billion. That's more than SPY at 24 billion. It's more than Nvidia or Tesla, which each do 16 billion. Imagine SLV doing twice that of Nvidia flows in a single day. We're seeing similar in GLD, but not quite as extreme. I think the last check was like 14 billion in flows, which is still big. That's still extraordinary. It's bigger than the futures contract. It's really an enormous amount of money coming into the ETF units and also the options for the ETFs. So right now, it's really worth focusing on the ETFs for gold and silver for your price signals, because that's where so much liquidity is pouring into. Speaking of gold, one of the things that we talked about in October of last year was this idea that money could flow out of Bitcoin and other cryptos and into precious metals. And the premise for that is simple. It's really, if there is a big crisis, are you going to have access to all of your crypto? Also, is it really a safe haven? Is Bitcoin really a safe haven when most of the time when there's a big sort of risk-off catalyst, whether it's a geopolitical situation or it's an economic situation, Bitcoin isn't getting a bid in those situations anymore. Neither is the US dollar. We'll talk about that in another chart. But I do think we're seeing some pretty big rotations out of crypto into precious metals. And I think that history of being monetary metals does matter in a changing world order, one that's becoming more multipolar as time goes on. And we have big buyers at the bid of gold. Central banks are purchasing enormous amounts of gold. And while this used to be a contrarian signal, no more. Nowadays, when central banks are stepping up to the bid, and you can see how much this increased after Russia invaded Ukraine and the West started really weaponizing the dollar and SWIFT, this is a paradigm shift. It's been going on for years, suggesting it's not going to be over anytime too soon. And this also suggests that this rotation that happens during risk-off events is likely set to continue as well. Before 2022, gold would actually fall when there is a risk-off geopolitical event, like a war or an attack or something else seeming like that kind of thing could be imminent. After 2022, gold rallies into those events. Before 2022, the dollar was bid pretty well. In fact, it was like a rotation out of gold and into US dollars during those types of events. Now, believe it or not, it's a rotation out of dollars and into gold, Japanese yen. And to some degree, there's a bit more of a bid to US treasuries, which is interesting given the backdrop of what we're talking about here. But nevertheless, the biggest beneficiary of this change in behavior, this sort of de-dollarization trend, which I want to be very clear, this is not the end of the dollar. It is a trend that reduces the demand for it. It is a trend that causes countries to look for other reserve assets, and that is part of what's helping to drive the bid for gold. Let's look at silver. This is just, wow. I mean, we have more than doubled since December. That's pretty incredible. Now, this is exactly the type of moves that silver tends to do during one of its rip-roaring bull markets. But this bull market, it stands apart. It is one of the most aggressive we've ever seen in silver, if not the most. And we'll talk about that in just a moment. But the pullback, the shakeout that we're seeing in SLV and silver futures, it would be healthy for it to continue. I wouldn't be too surprised if we see some sort of what I like to call chop-solidation or choppy consolidation. Silver likes to do that. It likes to sort of chop around and then just violently rip higher. There is that potential that it resolves this way, given how extended the flows and positioning have become everywhere outside the commitment of traders. When you look at the commitment of traders, you'd say, gee, it looks like no one's long silver at all. But then when you start looking at the calls, you start looking at the ETF flows and positioning, you could see actually there's a whole lot of people like us, retail traders, that are very, very, very long silver and having extreme FOMO about not being long enough silver. So it's like the professionals are just kind of like, I don't want to touch this thing, selling into strength. The home gamers are buying hand over fist. So let's talk a little bit about that. First, in the options, silver calls, SLV calls targeting 100 very aggressively. That's our call wall. We're seeing some roll up to 110 as well from there. So those are going to be levels worth watching today. 100, 105, 110. And we'll load these up in Bookmap so we can watch that a little bit during the trading session. One other thing that I wanted to talk about with silver is just this rally is absolutely bonkers. 511% over the last just about 6 years in silver. There's never been a rally like that in the metal in modern history, if ever. Now, while the biggest day ever was in 1979, if I recall, it was September 18th, silver climbed over 36% in a single day. The biggest rally that's extended over time is the one we're in right now for such a short period of time. The 1979 to 2000 peak is bigger, or the 1979 peak itself is bigger, but I would say that the magnitude of this move is absolutely insane. And so is the volume. This is volume into the SLV ETF. This is pure mania foaming at the mouth, bigger than what we saw during the 2011 FOMO surge, bigger than what we saw in the 2021 FOMO surge by multiples. This just says some degree of caution is warranted near term. But longer term, the backdrop is still solid. We've got a big spread between Shanghai and London, suggesting silver can continue to appreciate from there. I'm even told this spread is larger now. And we also haven't taken out silver's all-time high priced in real terms or adjusted for inflation. We've only recently taken out the price from 1790 adjusted for real terms, if you can believe that. And then just one last note on commodities. Commodities are deeply undervalued versus stocks and bonds, if you believe charts like this. I know charts like this have been going around for decades. Maybe one day they're really, really going to matter. I'd say if there was a chance that they mattered a lot, it would be over the next 10 years, this kind of a ratio, because we're going to see a big build out. Energy capacity, data centers, electrification, communications, all of this stuff is going to have a lot of demand for raw materials and resources. So I could actually see this being more meaningful this time around. And then with Bitcoin, it is trapped in a range. It is back to the bottom of the range. I'm not a huge fan of this chart. I do think there's some downside risk growing here. If we break the bottom of this range, we could retrace back to 74, 75,000 very quickly. Really, bulls are going to want to defend where we are now down to the bottom of this box around 84,000. You do not want to see us pulling too far below there. I think you could get some nasty continuation, because what's not shown on screen is that's just a giant low volume node. And if you chop through that, you're likely to see some price violence, and most likely to the downside. And here are our weekly pivots. I'm also going to share these out on social, so you can check them out on my X feed at Mayhem for Markets. If you aren't following me already, definitely check out the content I've got going on. Also, feel free to check out my work at Traderade.com. And you can pick up a copy of Bookmap for up to 40% off by visiting Traderade.com/bookmap. Just scroll down to the specials. And we're just about to dive into Bookmap. I realize the market is open. I was just a few minutes behind, but I had that really cool chart deck I wanted to share with y'all about everything that I'm seeing. And if you didn't catch all of that, you can go back to the YouTube or the X or whatever stream you're on and rewind it. All right, so we're going to close out that presentation, and we're going to dive right into the markets here on screen. Not a terribly eventful open so far. This gives me a chance to add some new instruments here. I'm going to add SLV and GLD today so we can watch some of the flows that are going on in those as well. We'll give them a minute to kind of settle in. One chart I meant to include was that of the dollar. It's starting to break some longer term trends. So that's another thing just to keep in mind with everything that's happening in the precious metals. Starting to see a little more volatility coming in. NASDAQ now getting back to the bottom of its trading range from the open. And natural gas is starting to have a bit of a risk-off moment here. Down 10% Output's returning. You know, that whole polar vortex thing is kind of in the rear view in the sense that there's not a whole lot more of that to be expected. And when we looked at the natural gas storage from last week, it wasn't really dropping quite as much to put it into a situation where supply was going to be crunched as hard as what was being priced in. So I did suggest on the Traderade Discord that we'll probably see a bunch of supply in natural gas up here, and we are starting to see some risk off from these higher levels. NASDAQ breaking to new lows. Let's take a look at just what's going on with the heat map here, what's leading the way lower. And it's looking like Oracle having a rough start to the day, down about 2.88%. Also, United Healthcare, wowza, down 18.5%. CVS down 9%. Elevance Health down 10%. The whole healthcare plans industry is getting absolutely clobbered. Humana down 20%. Just violence. I remember seeing some of the headlines about United Health. Apparently things didn't go so well on the earnings front. I didn't dive into that, but it looks like the market sure did today, and so did the stock. And NASDAQ continuing to see pressure. Outside of Oracle, there's not the same kind of big stock weakness in the NASDAQ. And we'll just quickly pull up a NASDAQ 100 heat map. And we could see, you know, Intuit's getting clobbered a bit. Adobe's getting clobbered a bit. Netflix is getting clobbered a bit. But prices are continuing to slip for the NASDAQ futures here. And this makes sense, you know, from the perspective of we've got a lot of tech earnings coming up. If you're already long this stuff, the only thing you can really do if you don't want to sell it is to do some hedging. And you could do that hedging by buying index puts. You could be buying VIX calls. You could be buying puts against single stocks. Any of those things tend to be liquidity negative. And so that could be one reason that we're starting to see some pressure to the downside this morning. Another is that we kind of opened up another trade war salvo last night with Trump saying that he was going to raise tariffs on South Korea to 25% on a number of their exports. And of course, there's the back and forth with Canada over China, and Trump talking about retaliatory tariffs against Canada as well. And one thing about any of this uncertainty, whether it's trade, the economy, tensions, otherwise, it tends to give a little bit more of a bid to precious metals and a little bit more of a risk-off feel for risk assets. Now let's take a look at SLV, and I am going to make some changes to this, so give me 1 second. Definitely seeing some interest in buying SLV here from the lows, from the pre-market lows, and really there was another attempt to push it lower right after the open, but we are making higher lows and higher highs here in SLV, so I actually really like the look of this open so far. If you want to see the stock heat map, go to finviz.com. And yeah, Loki, it is good to see a little bit of a shakeout in the precious metals for sure. And thoughts on Nvidia? Nvidia is consolidating for a big move, likely post earnings, but you can see that it's just been in this consolidation pattern for really the better part of 3 months, if not longer. You could even go all the way back to, say, September and say it's been in this consolidation pattern. Heck, you could say it started in August. We really haven't done a lot since then. So suffice it to say, that's about 5 months of consolidation. And the longer something coils up, the more likely it is to have an extended resolution to that. And the primary trend in NVIDIA is up. So assuming that they're able to impress investors, you have some coiled up energy that would want to be released to the upside. So I think the path of least resistance is getting back to those highs, around 210 in NVIDIA, assuming that they're able to impress investors with their earnings. Now, if they're not, you've got a lot of de-risking that could happen in this thing, and I think it could very easily come down to about 140 on a nasty miss. I don't see that being a likely scenario. I think that there is still a lot of pent-up demand for NVIDIA's products, for memory, for storage, for CPUs, and you're seeing that in the pricing. There's shortages of all kinds of different hardware out there. Prices of flash memory and RAM memory have gone up anywhere between 200, 300, 400%, depending on the segment. NVIDIA's GPU and VRAM demands are so high that they're actually phasing out the 5070 cards from production because they just simply don't have enough parts available. They'd rather sell them to data center customers. So that suggests that there's still a lot of demand for NVIDIA GPUs and NVIDIA products overall. My thought would be that, eventually you're going to see more competition and margin compression in this space. This is sort of the trend that happens with semiconductors when they have a new product and one company is more of a monopoly. They're able to be very aggressive with their margins. And NVIDIA is, of course, with their data center offerings, I think 73% margins or so. But that's also, if you look at it from like a Jeff Bezos perspective, your margin is my opportunity. The semiconductor space is traditionally lower margin. So eventually I do think this shakes out. The question is when, and it may not for years, quite frankly. So I don't think that, for folks out there, like, when do we bet against NVIDIA? I don't think that time is here. I don't know that the best upside opportunities are going to be in an NVIDIA either. It's probably going to be in other parts of the data center ecosystem, the networks, the raw hardware parts, although the appreciation we've seen in prices of stocks like Micron and SanDisk have kind of priced me out of wanting to bid now. I did have a really juicy Micron long. I recently closed that out. I talked about the breakout over the summer. You can see those posts on my Twitter feed. And I'm still long Google. I've been long Google and adding to that on weakness last year significantly because I believe the TPU story, and I believe that Google, who invented transformer models in 2017, was going to be a leader in this space, and they are emerging as just that. So I think there will still be other opportunities out there. I'm still a buyer of a company like Google on its pullbacks. Eventually, Oracle will be a buy as well. That's a stock that I've had in my long-term portfolio since, low double digits. And I still think that it's got a little bit more shaking out to do. But eventually, Oracle's also going to be a conviction buy. Probably not terribly far from current levels if we're looking at it. Like, I'll just see if I can pull up a chart on screen real quick just to show you what I'm talking about. And I'm just going to put some crayon lines on there too, just to kind of show what I'm trying to say with this. All right, so we'll pop this on screen. This is just a chart of Oracle Commons. This is a monthly chart. We're going back quite a ways. And this is the line that ends up being the buy zone, but you can see sometimes we get these head fakes below that are pretty violent. So I think it's time to start looking at Oracle pretty seriously, but don't be too surprised if you get some head fakes that end up being buying opportunities from this long-term trend. So that would be my base case for Oracle. We're very close to the buy zone. Of all the companies in the AI space, this one's seen such a violent de-risking on account of concerns around its debt and the AI capex narrative. I would just take the other side and say near term, there's some swing trades setting up on this thing. If we can see it kind of defend this line, that's going to make me a lot more aggressive about wanting to buy back in for longer term swings and even some investments. But for now, I think it's time to at least keep it on your shopping list, set some price alerts around 170 and below, see if we get another one of those fakes, and then also set price alerts at 180 and above to see if we can confirm this trend line and that it is support. And you might remember last year when this thing was surging above 350, I was selling 350 calls against my long-term holdings on it because I felt like there's no way this made any sense. I did some de-risking after those calls. It became very clear that those calls were not going to get my shares called away. Having sold them, I started to do some more de-risking around here. But I'm ready to start adding back to Oracle real soon. I think this is a company that longer term, it's hard to bet against General Zod. That's what I call Larry Ellison. If you're not familiar, that's a supervillain from Superman, who he bears striking resemblance to. And no matter what you think about Oracle, they tend to do well over long stretches of time. So that would be one I'd look at as a potential kind of contrarian play in this space. Welcome, Danny. Welcome, Alice. Welcome, Matt. Welcome, Jeff. Welcome, Lynn. And getting another question here on X. Do you like some of the other metals that are skyrocketing like palladium, platinum, lithium as a way to diversify if we are heavily invested in silver and gold? Is there a fundamental reason for these moving higher, or are they a sympathy trade? I love this question. By the way, seeing a big bid come back into the S&P futures and NASDAQ futures here, but I want to talk about that question really quickly. So first of all, let's just talk copper. Copper, this is a monthly chart of copper. This really looks structurally sound to me. I think that copper is destined for new all-time highs from here. We can even zoom it out to a daily if we want. But this is still a very constructive chart, consolidating recent gains, building some acceptance at these higher levels. I think copper has structural deficits going out at least a decade. And this is far beyond what mining is going to be able to bring on anytime soon. So Rick Rule likes to say the cure for high prices is high prices, and he's right. The higher these prices go, the more production will be brought online. But on the other side, there is a delay. You can't just like spin up a copper mine right away. It can take a very long time to bring that supply and capacity online. So that's one thing to just keep in mind here, that in terms of the metals, there is actually a bid beyond the market. There's a bid for things like copper because of the electrification story. Not only do data centers need to be connected to power, copper is also used for networking, it's used for making motherboards, and it's used for all kinds of different purposes throughout the economy. So as you see that investment growing in China, in the US, in Europe, who's also building a lot more power capacity for data centers, copper prices are likely to move higher. So still very bullish on copper over the long term. Another one is palladium. Now, palladium just broke out to a new all-time high recently. On the Traderade Discord, we talked about starting to get long around here and up to 1,500 and then breaking above there up to 2,000. So we've had the big move that we wanted to have with palladium. We've realized some pretty significant gains and then de-risked off that. I'm still looking for another good opportunity to long this thing. I think it still moves higher, but I want to find a better risk to reward setup. But over the long run, I could see palladium prices continuing to move higher. So if we take this to a monthly chart, What a beautiful rounded bottom this is. And breakout from that. You know, you can see the breakout from the old resistance area that was at one point really a ceiling for prices. You could see how long it had acted as a ceiling. You could say maybe that's about 1250, 1260. Once we busted out of there, it was like a rocket ship higher. And now we're in the great supply zone. So if you look at the prices from the prior peaks in palladium, right here is an area where I would expect a lot of volatility because there's still a lot of overhead supply. So for now, kind of hands off palladium, but I think if we can chew through this supply, there's no reason we can't get back to 3,000. Platinum is another one that I've been bullish on and that I continue to be bullish on. I do think that this is something to really pay careful attention to because platinum is used a lot in semiconductors. It's used in transport for catalytic converters. It's used in a number of industries. And I think that this is still the early innings of ultimately how this move can resolve over the longer run. So platinum is another one to keep on your books, but I don't really want to be buying into parabolic moves. So, you know, if I was looking to get a long into platinum, I'd look for a period of consolidation or correction to start building that position. I wouldn't necessarily want to be buying it here, even after it's pulled back a little bit. It's still pretty extended. Similar view on gold and silver. If you're not already in, I wouldn't want to be bidding here. I would really want to be looking for some kind of a pullback. And people would say, well, when this thing pulls back, it pulls back for 10 seconds and then it's up and away. That's probably not sustainable. So just be careful with your FOMO on stuff like this. That would be my big takeaway. And silver prices starting to come off their highs. We saw SLV run all the way up to 100. We know there is a call wall on SLV 100, and we rejected from there. Really got right up to it and rejected. So I think that is meaningful in the context of what we're talking about with options playing a role in silver, but also in the context of just how top heavy this thing has become with so many people buying, that you're going to see a lot more volatility. And you'll probably see this in both directions. You'll see, you know, days where silver could be up 10% and down 10% in the mania phase that we're in now. And it is a mania phase. You're seeing record retail volume. You're seeing enormous amounts of call buying and ETF buying in the SLV ETF and other ETFs in the miners. This is not early innings for where we are in terms of the interest. It may be early innings in the long term of where silver's price can go. I wouldn't be terribly surprised when all is said and done for silver to be $200, $250 an ounce in 2 years. But near term, it would be much healthier for this thing to consolidate or even correct, shake out some of the loose hands, get some people kind of bored of it, so then it can do what it loves to do and just rip face, surprise everyone. But with it as sort of everywhere outside of commitment of traders, the positioning in silver is heavy. So that's the one thing to keep in mind. Big move higher in S&P futures here too. Getting above that 7,000 level. So starting to push above the top of that range we were talking about a little bit earlier. And so 70-30 on screen as the wall of calls for ES. That could be an area of resistance. I would be surprised if we're able to overcome it before, you know, we get through this week of earnings. But this week of earnings could be the catalyst that helps to push us above it if we get some solid results. Wednesday is a big day for that, as is Thursday. Wednesday we've got Microsoft, Tesla, and Thursday we've got Apple. Seeing some selling pressure in SLV pick up here. We did cross below the point of control. Sellers got a little bit more emboldened. You can see that, allowing them to push to new lows. Tried to get back up to it. Buyers got pretty aggressive, and that just allowed sellers to make another push here. You can also see in the order book here, this is nothing like yesterday. If you're tuned into my stream yesterday watching silver, we talked about the order book being very bid heavy. Today, Not so much. That delta is much flatter than we saw in previous days for SLV. That's another thing telling us the demand is not as strong as it had been. It's expensive here. What can I say? I mean, I'm still bullish on silver. I have physical from the single digits of price that I still hold. But at the end of the day, this move went too far, too fast, and a shakeout is very healthy in the precious metals. If you're bullish of them, that's what you want to see. If you're bearish of metals, you actually want to see them continue to run parabolic so they actually crash. I would rather see them correct and consolidate so that they don't crash. That would be my hope here, that we have a little bit of a cooling off period. Now, February tends to be seasonality poor for silver, but good for gold. So the other thing is you might see that gold to silver ratio reset a little bit in February, with gold outperforming silver and silver just sort of consolidating or correcting a bit. That would be ideal. I know this hasn't been a time where seasonality's meant a lot, but you never know. Over the last 5 years, February has been pretty tricky for silver. Someone asked me, why do you look at such short time frames for seasonality? And I would say things change so quickly that if you look back too far, you're going to get too much noise in your data. Really, a 3 to 5 year look back on back testing and seasonality is about all you need. That's my 2 cents on it. S&P futures continuing to push to new highs as silver continues to push to new lows. And folks, if you want to learn more about my work, visit Traderade.com. I offer one-on-one trader coaching. We've got a great Discord community, a lot of awesome trading tools and actionable research. And then you can use the code Mayhem20 for 20% off your plan. Also, check out Bookmap. You can get up to 40% off by visiting Traderade.com/bookmap. Scroll down to the special offers. And of course, I will be back next week, Tuesday at 9 a.m. Eastern for the next episode of Back to the Futures with me, Markets and Mayhem. I want to thank all of y'all for tuning in. I really do hope you enjoy these streams. It's all about the education, having a little fun. And remember, with markets, don't take yourself or them so seriously that it starts to jar your emotional well-being. Remember, we should have fun. We should treat ourselves well, no matter how well or poorly the market is treating us. And we shouldn't bind our emotions to money-related outcomes. That's my little nugget of wisdom I want to leave y'all with, because it's so important that you keep your mindset healthy so that you can continue to build, to perform, to get more consistent and disciplined, so that you can eventually build the kind of wealth that allows you to secure financial independence. That means not going on tilt. That means not revenge trading. That means trading by a system, only putting on trades where the probabilities are in your favor and not trading just for the sake of trading. Appreciate you all. Hope you have an awesome rest of your trading week. I will be back to cover some of these big earnings releases, so stay tuned.